As we look at the screens today, Tuesday, December 23, 2025, D-Wave Quantum Inc., trading under the ticker QBTS on the New York Stock Exchange, is seeing an absolutely massive move in intraday trading. The stock is currently priced at $31.86 USD, which represents a staggering gain of 5.05 points or 18.84% today. This kind of movement is the sort of thing that stops every trader in their tracks, especially when you consider that this isn't just a low-volume retail pump. We are seeing a significant amount of institutional weight behind this push. While most retail traders are busy checking their positions in Tesla stock or wondering if Nvidia stock can maintain its current multiples, the real action today is happening in the specialized hardware space. This price jump isn't just a fluke, it's a reaction to a market that is finally starting to see the distance between expectation and reality closing in on a technology that many thought was still a decade away. The expectation that most people have about quantum computing is that it's a science experiment. Most investors look at D-Wave and think they are buying a ticket to a show that doesn't start for years. But the reality is that D-Wave is already running production workloads for over 100 organizations. That is a huge disconnect. While you might use your individual brokerage or a Fidelity trading platform to buy into the big tech names, the smart institutional players are looking at the specific niche where D-Wave operates. They aren't just looking at this as a speculative play. They are seeing a company that has managed to clean up its balance sheet and put itself in a position where it has over $836 million in cash. That is a fortress of a balance sheet for a company that was once considered a risky startup. If you're using an app like Robinhood for your Robinhood stock trading or managing a portfolio through SoFi Invest, you've probably noticed that the high beta names are the ones driving the most conversation. But D-Wave is different. The volume we are seeing today is reflective of a shift in sentiment. We are seeing institutional activity from firms like Vanguard and Charles Schwab Investment Management increasing their stakes. Even those utilizing Schwab Intelligent Portfolios or other automated investing sites are beginning to see exposure to these emerging technologies. The reason is simple. D-Wave is currently the only firm that is commercially delivering annealing quantum systems at scale. While others are still trying to figure out how to keep their qubits stable for more than a fraction of a second, D-Wave's Advantage 2 system is already out there solving optimization problems for logistics, manufacturing, and even national defense. The market narrative has always been that quantum is too early for an online investment strategy. People often stick to what they know, like Apple stock or broad market index funds. But when you look at the actual data, you see that D-Wave's revenue grew by 100% year over year in the third quarter of 2025. Their bookings are up and their gross profits are expanding at a rate that should make any growth investor take notice. This isn't just about selling a dream, it's about selling a service. They've moved from proof-of-concept projects to multi-year commitments from major corporations and even government bodies. Speaking of the government, the formation of their new U.S. government business unit is a massive development that the market is just now starting to price in. This unit is specifically designed to handle the growing demand for quantum applications in national security and public safety. When you see a company take a dedicated step like that, they aren't just hoping for contracts, they are preparing to fulfill them. It's the kind of strategic move that makes a Fidelity brokerage or a Fidelity wealth management advisor look twice at the ticker. It's no longer about whether the technology works, but about how fast it can be deployed within federal infrastructures. Now let's talk about the competition and where D-Wave sits in the broader landscape. If you're into self-investing or use interactive brokers trading for your portfolio, you know that the sector is crowded with names like IonQ and Rigetti. But D-Wave is playing a different game. They are pursuing a two-pronged approach. On one hand, they have their annealing technology, which is perfect for optimization. Think about an airline trying to figure out the most efficient way to route thousands of flights while accounting for fuel costs and crew schedules. That's an optimization problem. Classical computers struggle with those as they scale, but D-Wave systems eat them for breakfast. On the other hand, they are also developing gate model systems, which are better for things like chemistry and simulation. By doing both, they are covering the entire market. This brings us to a point where we have to ask, is the current price justified? A lot of people using investing sites or a Robinhood app might see a 27% year-to-date run and think they've missed the boat. But look at the analyst targets. We have firms like Jefferies and Wedbush coming in with price targets as high as $45 or even $46. They are seeing the same thing the institutions are seeing. A company that has successfully navigated the difficult transition from a research entity to a commercial supplier. When you look at your Fidelity mobile app and see these ratings, it becomes clear that the professional side of the street is much more bullish than the casual observer might expect. One thing that is particularly interesting about the movement today is the options activity. We are seeing a lot of bullish flow on the call side, which suggests that traders are positioning for even more upside as we head into the new year. If you use a SoFi trading platform or Interactive Brokers platform, you can see that the bid-ask spreads are tightening even as the volatility remains high. This suggests a healthy amount of liquidity is entering the stock. For those of us who focus on online investing, this liquidity is essential because it allows for larger positions without massive slippage. Let's take a step back and look at the actual business model for a second. D-Wave provides their services through a cloud platform called Leap. This is genius because it lowers the barrier to entry. A company doesn't need to spend millions of dollars to buy a physical quantum computer. They can just subscribe to Leap and start running their workloads. This recurring revenue model is exactly what Wall Street loves to see. It provides a level of predictability that is usually missing from high-tech hardware companies. It's why you see so much institutional interest from the likes of Fidelity mutual funds and other large-scale asset managers. They aren't just buying into a hardware manufacturer, they are buying into a software-as-a-service play with a hardware moat that is nearly impossible to duplicate. The recent third-quarter report was a significant catalyst for the price action we are seeing now. Revenue of $3.7 million might sound small compared to a giant like Apple, but for a pure-play quantum company, a 100% year-over-year increase is massive. More importantly, they've managed to clean up their equity structure. By redeeming their public warrants, they've simplified the cap table and brought in an additional $54 million in cash. This means less dilution for common shareholders in the future, which is something that anyone doing investment help or looking for the best investment opportunities should be paying close attention to. Comment below how many shares of QBTS you currently hold, or if you are planning to add more before the year ends. I'm curious to see how many of you are playing the quantum space versus sticking to the more traditional tech names. The macroeconomic environment is also playing a role here. As the Federal Reserve's policy becomes clearer and the market starts to look for growth in a post-inflationary world, companies like D-Wave that offer unique value become very attractive. If you're managing an individual brokerage account or using SoFi Active Investing, you're looking for that alpha that isn't tied to the standard tech cycle. Quantum computing is its own cycle. It doesn't rely on the same consumer spending trends that drive other sectors. It's driven by the need for efficiency in the corporate and government sectors. This makes it a great diversifier for someone who already has a lot of exposure to traditional online investment options. We also need to consider the risks. Even with a cleaned-up balance sheet, D-Wave is still burning cash. Their net loss for the quarter was still significant, even if it was better than expected. This is the reality that often gets lost in the hype. While the expectation is a smooth ride to the top, the reality is that the road to profitability is long. This is why many advisors at places like Fidelity Wealth Management suggest that these kinds of stocks should only be a small portion of a well-rounded portfolio. If you are using a SoFi robo-advisor, you might not even see these names in your automated picks because they are still considered high risk. But for the self-investing crowd, the risk-reward profile is starting to look very enticing. The upcoming CES 2026 showcase is another catalyst that people are looking forward to. D-Wave has already announced that they will be showing off their real-world customer success stories. This is important because it shifts the conversation from what can it do to what has it done. When companies like BASF or large international airlines stand up and say that D-Wave saved them time or resources, it validates the entire industry. It's a lot harder to call something a science experiment when it's helping a global logistics company optimize its supply chain. For those of you using Fidelity IRAs or other long-term accounts, the question is whether D-Wave is a buy and hold stock or a trade the volatility stock. Right now it looks like a bit of both. The 18% move today shows that there is a lot of room for quick gains if you catch the right wave, but the long-term fundamentals suggest that we are only at the very beginning of the commercial adoption curve. If you use Robinhood Investments or SoFi stocks for your trading, you probably know that these moves can be violent in both directions. That's why it's important to have a plan and not just chase the green candles. Looking at the technicals, the stock has cleared its 50